Good day, ladies and gentlemen, and welcome to our class on learning to build your own profitable strategy. Now, in this class, we'll take a look at my triple header strategy, but we're going to learn about how you can build your own strategy and what you need to do and how you can combine it together. So there are probably as many trading strategies as there are traders, but not all trading strategies and trading plans are created equal. I suggest that you find some strategies and then build a trading plan around them. There are a plethora of trading strategies available to you, but I also encourage you to create your own strategy. Now, if you like, while you're on my YouTube channel, you can take a look at several strategies that we've set up. We have our support and resistance strategy. We have our 1, 2, 3 strategy. We have our indecision candle strategy. We have also, what else do we have set up here for you to see? We have a lot of strategies. So stop, but don't just follow them blindly. Learn from them, practice them on a demo account, and then start modifying them to build your own. So when you build your own strategy and test your own strategy, you are the master and you understand all the ins and outs. And you are not just trying to duplicate my thought process or somebody else's thought process. So I always encourage traders to develop their own trading strategies, time permitting. There are several reasons why I believe it's important for traders to develop their own strategies. First of all, creating strategies requires the trader develop a greater knowledge of the market and its price movement, because it means you have to use what you're seeing on the charts. You start dealing with your assets on a one-to-one level. You start to get to know their personalities, and therefore your strategy works with you, the assets you trade, and how you think. Secondly, when one develops their own trading strategy, they are tuned into how the strategy actually works, because you need the little tiny minute details. Because unless you're in my brain and you're trying to follow my strategy, I can't explain everything step by step in every thought process. I can give you generalities, but you still have to drill into my brain to get all of the thoughts. Same thing with anybody else. And a lot of these strategies that are pushing on the internet work for a week, work for a month, work for one particular asset, or this guy used it a couple times and now is telling you it's the greatest strategy in the world, and he's showing you little recordings of his trades, how he made money. Just the other day, one of the most successful online analyst traders, who's got a huge following, it was revealed that he's rigged the trades. Not rigged in the market, but the videos that he was inserting and the movement of his trade and how much money he made were found to be completely false. That he used creative graphics to enhance the success rate. So please don't just blindly follow some blurbering guru on the marketplace. But you don't need to start from scratch. You can take one of these fools or one of the better guys or one of the gurus or myself or another well-known analyst and start with theirs. But again, trade it on a demo account and create it and use it and make it work for your assets, and write your own rules down and then adjust it so that it's yours. So I understand that this is a time-consuming part, but it can also be fun. Because too many people want to think that trading is just getting online, It's not the work. Well, the work is the rewarding part. When you do the work and then you have successful, profitable trades, you get the reward. So how do I generate my strategies? The first thing I do is I watch my charts. I look at past and real time. I try them in demos. But what I look for first are trades that I didn't make, trades that I didn't see. I look for where an opportunity was that I wasn't even aware of it. And then I say, okay, how could I have made money and how could I have been aware of that opportunity? So I start backtracking. Okay, what happened here? What happened there? What were these indicators like at that time? And all of a sudden, I've got something new that I can start developing. To give you the perfect example, a couple weeks ago, Bitcoin had been trading steadily at 9,000, 10,000. Now, I have a couple Bitcoins, but I don't really trade them. But I do technical analysis for cryptocurrencies every day. So I'm giving my chart, sharing them with a whole market. So I need to understand what's happening there. And Bitcoin was trading at 8,000 and 9,000. And then 10,000 stayed around 10, between 10 and 995. It was doing all right. Then, of course, we know what happened. We had the crash from, coronavirus. But all in January, Bitcoin kept increasing and everybody was touting it as one of the new safe havens. Now, I did not expect Bitcoin to fall in one day from 9,000 down to 7, then down to 3,900. Now it's steadied itself in the fives. But I had to go back and look and say, how come I didn't see this? How could I have taken advantage of this? I mean, that would have been one hell of a short trade, just getting Bitcoin to ride down from 7 to 4, 7 to 3, 7 to 5. That would have been a nice, profitable short-term trade. Okay. How come I missed this? Okay. Now, what could I do, or what could I have seen that would have predicted this for me? And I'm slowly trying to work it all out and test it on a couple other digital assets to see if it'll work. Now, I needed to duplicate this over and over again. So you can back test. You can use, there's all types of websites and scanners you can use to back test. You can go back in the markets way back when and put your strategy in and see how it works going forward. Okay. Or you can keep using it forward, but on a demo account. But it's not work. If you turn it into fun, it can be quite enjoyable. In the short, you want to analyze your charts looking for opportunities. Examine those opportunities and construct how to turn those opportunities into real money without exposing yourself to excessive risk. Once you've gone through several opportunities in this fashion, you'll be well on your way to creating a profitable trading strategy. So we want to see if the strategy worked for more than 20 trades. We want to see if it, and now you have to remember, not every strategy does everything. You can have a strategy that's very good at giving you buy and sell alerts. You can have a strategy that just generates entry and exit points. You can have a strategy that will help you find your stop loss, or you can have a strategy that tells you when to get out of the markets. Okay? You don't have to use one. To come up one for everything is really tough. But this is what demo accounts are for. And if you can trade the strategy successfully for at least 2 months, then maybe you want to consider using it for real capital, but be really careful. So what we have to do is we want to test and modify. But as I said, you don't need to reinvent the wheel. You can learn from trading analysts and experienced traders. They are still in the market because they are successful. Study their strategy and learn from them. Don't follow them blindly, but test them out what they are saying and then modify it and make it your own. Always include some fundamental analysis. Okay. When you say, I'm a technical chart trader, I'm a price action trader, I'm a chartist. Well, I'll give you the perfect example. Okay. 2 weeks ago, I had an absolutely beautiful setup on the euro, the US dollar. Everything was doing exactly what it should be. Okay, and this is the day that the euro moved up to 114, then fell to 111. Now, I didn't think it would ever make it past 111. Okay. And I had my trade set up, but I didn't look at my calendar that day and didn't realize that Christine Lagarde was making a public speech. And she was going to be talking about what the ECB could do to help in this time of coronavirus and how they were prepared and what they might be doing to help stop economic downfalls. Well, the euro still went up to 111, went to 114, came back to 111, except what happened was I didn't peg the volatility correctly. And her speech sent the euro way up and way down and way up and way down. So my stop loss was way too close. And what would have been a successful trade, I got stopped out of. Only because I didn't realize that there was some type of fundamental things going on that would create a market volatility in that one time frame. So you should always look at fundamental analysis. Now remember, not one strategy for everything. You have to decide what you want to accomplish. Do you want trading signals? Do you want entry points? So needless to say, the first step in technical analysis must be the identification of the market with which a trader is interacting. And I harp on the thing with the problem with online trading is it offers you too many assets and too many classes of assets. I mean, I have students that are trading Bitcoin 1 minute, the euro the next minute, Apple later, then they're back over to oil, and then they're back over to Facebook, and then they're back over to the FTSE, and then they're trading the S&P, and then they're jumping back to the NASDAQ, and then they're back to Ethereum. Well, you cannot be an expert in that many market sectors, nor can you be an expert on that many assets. And therefore, you're going to eventually lose because you just can't keep track of all of that information and trade all of that information. And some strategies will flow from one market to the next. But most strategies don't work as well, for instance, in the gold market as they do in the euro and the Forex market. Some strategies work great for cryptocurrency, but don't work good for indices. That's the first thing. Second thing is there's so much stuff going on. Just because you see something doesn't mean you should trade it. And being an expert in a small group of assets makes you a lot more knowledgeable. Now, I always use trend lines. I always use support and resistance. First thing I do every morning is I look at my trend lines. I make sure they're correct, make sure if they have to be changed, I have to change them. And I also have to verify my support and resistance levels. And if the asset moved up or down, I have to make sure that my other ones are brought forward. And that I always have those in chart. Whether I'm even have a trading opportunity in a particular asset, they're always on my charts at all times. So these are basic parts of things you should do. Okay, so you don't actually have to incorporate them into a strategy because you already have them there. It's not work you have to do. Now, support and resistance should be part of every strategy, used for every entry point, every stop loss, because it can give you some warning. Now, on the basis of criteria discussed, we must pick the appropriate technical tools for the chart we examine. If the market is trending, there's little point in using RSI. If it's ranging, the moving averages are unlikely to be of much use. If the underlying currency pair is strongly cyclical, or if the currency pair is issued by a commodity exporting nation, the CCI could be a good choice. If it is a highly volatile, smoothing out the fluctuations of moving average crossovers could be very beneficial for identification of the trend. So that's what I'm saying. There's different strategies incorporating different things depending on markets and assets. Of course, this list can be extended, but this list could go on and on and on and on forever. A trader must define his approach to trade over time by deciding on the kind of indicators which he understands best, and then combining them later to form a simple and concise method. Now, for instance, I use support and resistance. I use trend lines, and I use chart patterns. I am a king of trading triangles. I trade triangles, period, chart patterns, but mostly triangles, support and resistance, my trend lines, volume. If I can't understand what's going on, I might add an indicator. But that is it. I like to keep my stuff simple. But that doesn't mean you have to. But upon deciding the technical tools, the analyst must decide on the periods and the ranges for which values must be supplied. Are you going to trade from a 5-minute chart? Or are you going to use a 1-hour chart for an environmental look and to decide whether you're going to go long or short, but you're going to use a 5-minute chart for an entry point? You have to decide this, but this is part of your strategy. So once the technical tools are set up, we must now seek the signal that will show us that a trade opportunity created by investor sentiment or temporary imbalance in the market give us an opportunity. So regardless of what time frame you use, whether it's 1 minute or weekly, you will see where the price has moved up. Okay, you'll look at the support and resistance. Look at your chart. Look at a series of low points where price does not fall below any further point. This is your support level. Look for a series of high points where price does not rise any higher, and this becomes your resistance level. The more price bounces off of these support and resistance levels, the stronger the level becomes. Once a support level has been defined, draw a horizontal support line, and wait for price to fall back to that support line. Okay. Now we have whole classes in support and resistance trading, understanding support and resistance, eyeballing support and resistance. But support and resistance is one of the easiest indicators to use. Okay. Now, as you see on the little chart here, how we've drawn our support and resistance levels on, what happens as price approaches the support and resistance level. But it's not that simplistic. But if you just trade from support and resistance, you'll lose your shirt. Okay. But it's a good starting point. Okay. Then you can combine that with volume. Okay. Price hits the support zone and bounces off it, volume increase. Okay. Right away, we know we have price is probably going to move up. If you had a triangle on that chart and it broke out heading to resistance or to support, you even have more information. So many traders consider price action to have a special relevance when identifying support and resistance. One very compelling reason: the market has actually traded this price at the specific levels. And the more times it's hit that support or resistance level, the better it is. So now we have the beginnings of a strategy, but we must add one more indicator which will serve to give us more market detail in a different manner. So there's all types of technical indicators. I use, if anything, MACD. Okay. And there's a whole class on here on mastering MACD. There's an entire class on RSI. There's one on stochastics. There's one on fibs. And you're not going to learn that. You'll learn the basics in 1 hour, but you still have to understand all the details. Okay. And you could combine them together into one strategy. So I'm going to share with you a little presentation on how you might want to combine a couple indicators and moving average to build confluence and look at price to make a market decision and enter a trade. But all of this is up to you to do on your own.
Indicator 1, RSI. The Relative Strength Index compares the magnitude of recent gains to recent losses in an attempt to determine overbought and oversold conditions of an instrument. As you can see from the chart, the RSI ranges from 0 to 100. An instrument is deemed to be overbought once the RSI approaches the 70 level, meaning that it may be getting overvalued and is a good candidate for a pullback or reversal. Likewise, if the RSI approaches 30, it is an indication that the instrument may be getting oversold and therefore likely to reverse. Traders will often use the RSI either coming back out of its overbought or oversold areas as a signal or partial signal to enter a trade. As we can see, the RSI is often accurate when indicating when a market will reverse. A trader using RSI should be aware that large rallies and drops in the price of an instrument will affect the RSI by potentially creating false buy or sell signals. Traders often combine the RSI with other indicator signals, such as MACD crosses. Indicator 2, MACD. The moving average convergence divergence is one of the most well-known and used indicators in technical analysis. This indicator is made up of two exponential moving averages which help measure momentum in an instrument. These moving averages and the changing distances between them become the MACD. Convergence simply means the moving averages are moving closer together, and divergence simply means they are moving away from one another. When the shorter-term moving average is above the longer-term moving average, this area of the indicator will show activity. When the shorter-term moving average is below the longer-term moving average, this area of the indicator will show activity. The centre line, of which the MACD is plotted around, indicates where the moving averages are equal, and when the MACD passes through the centre line, this indicates the moving average is crossing. The signal line, here in red, is a moving average of the MACD values themselves. Typical values for the MACD are 26 and 12 exponential moving averages, and 9 for the signal line. The farther apart the moving average is, and the greater the momentum, the farther away the MACD will be from the centre line. Traders use MACD and signal line crosses, such as these, to indicate momentum trades. You can see how these crosses often match up with market moves. Traders also use the MACD crosses to indicate when momentum is coming out of the market, and may use it as a signal to exit a trade. Indicator 3. Bollinger Bands. The Bollinger Band starts off with a simple moving average. It then has two standard deviations plotted away from it. That sounds a mouthful, but the important part is because standard deviation is a measure of volatility, Bollinger Bands adjust themselves to current market conditions. When the markets become more volatile, the bands widen, move further away from the average, and during less volatile periods, the bands contract, moving closer to the average. The typing of the bands is often used by technical traders as an early indication that volatility is about to rapidly increase, as volatility often follows periods of lack of volatility. The markets spend most of their time within the bands, and when the price action reaches the edge of the bands, it is often more likely to reverse and come back into the range. This is used as a signal by reversal traders to take a trade. This is similar to the oversold and overbought conditions of the RSI. Indicator 4. Super Trend Indicator. The super trend indicator is an excellent indicator of trend direction. It can be used as a foundation of a trading system that is based on trend following. One of the most popular ways to use this indicator is to enter the market after a pullback. For example, if the market is in a downtrend, indicated by red, wait for a green pullback and then re-enter the market once it turns red again. The same can apply in uptrending markets. Here we can see how this indicator accurately tracks market trends. It can be refined to the settings to match the specific instrument. Indicator 5. Confluence. The last indicator isn't a new one. It's indicator confluence, which means to use multiple indicators and their signals to take a trade. Here we have the RSI and MACD we looked at. We have the RSI moving into overbought territory here. Remember that indicates the market will reverse. However, we want to help us filter out false signals in the RSI, so we also look at the MACD to give us confluence. We can see that it's indicating momentum has come out of the market, as far as the market rallying or going up is concerned, and we have an MACD cross here. A signal to enter this short trade could be waiting for the RSI to come back out of overbought and also waiting for the MACD cross. We can see that those combined signals are an indication that captures this trend. You can also use the opposite signal to indicate when the momentum is coming out of the market and it's more likely to reverse when the market retraces back up the opposite direction of the trade, and therefore there's an exit signal. In addition to the RSI and MACD signals, we can add further confluence to this trade with the Bollinger Band and the super trend indicator. We can see the market is at the top of the Bollinger Band here, but we should also wait for the super trend indicator to change up here before taking a short trade. Now we have the confluence of four indications. We have an RSI coming back out of overbought, we have an MACD cross, we have the market going to the edge of one of the deviations on the Bollinger Band, and we also have the super trend turning back to red. Indicator 1, RSI.